Interesting is that in fixed income markets, particularly bond markets, there's been a lot of innovation over the last 5 years, a big push for electronification, electronic trading. But interestingly, there hasn't been a huge focus from regulators on this market. I think particularly in the US, the SEC, one of the big overseers of fixed income markets, has had their hands full with more equity market challenges, concerns about sort of retail consumer protection issues. And so while there is a focus, there is a working group there, there haven't been any major proposals for big changes to the workings of the bond markets. Interesting, though, I think what will come over the next 6 months or so is, a look back at what did really happen in March and April. There certainly were big liquidity gaps there. Sort of early analysis, and from the market's perspective so far, right, it doesn't seem like there was a market structure failing, if you will, right? This was purely an economic problem. But we should definitely expect regulators to take a closer look at markets to understand how they worked, what went on in that acute phase, and maybe if there is anything that should be done to help alleviate that potential in the future. We could see some of that. But I think for fixed income traders at this point, right, the focus is more on sort of good old fashioned market dynamics and making sure they have access to sort of the latest and greatest technology, which is increasingly driving activity in those markets as well.